There's a cliche that says if something sounds too good to be true, it probably is. That's the case with Robinhood and the allegations that they had violated state and federal securities laws. Welcome, everyone. I'm Justin Paperny with Compliance Mitigation, and we're going to cover a case study today with Robinhood, who was investigated and sued for violating state and federal securities laws. Now, of course, Robinhood has been in the news a great deal of late with everything that's been taking place with Reddit and the game shop company and all of the trading that's been taking place. This company is growing. They're raising billions of dollars. I read this morning they're going to have their first Super Bowl ad this Sunday. So Robinhood is in the news a lot. And in this case, we're going to talk about some decisions they made previously that brought them into the eyes or the clutches of government investigators. And you can expect more government investigations for all sorts of businesses because we have a new administration. It's going to be a bigger government and more investigation. So let's transition into this case study of Robinhood. Many of you may know. If you don't, I have experience in the financial services industry. I was a stockbroker for many years, so a lot of these terms I'm familiar with, although I certainly want to make sure that we're on the same page as we go through the objectives for this case study. We want to explain how failure to properly market products and services may lead to civil liability. Understand the responsibility a company undertakes when acting as an intermediary in the purchase and sale of publicly traded securities. Describe ways in which a company might take additional precautions in protecting itself from accusations of fraudulent conduct. Of course, that's what we do at Compliance Mitigation. To learn more, go to Compliance Mitigation. You should enroll in our Compliance 101 program. Our work isn't just for those involved in a government investigation. It's also to help prevent companies from having a government investigation begin. And it just starts with compliance. And of course, if unfortunately a government investigation ever began, there's a chance the sanction could be less if you say we have a compliance program in place. So whether you're involved or in a government investigation, you just want to avoid them. You need compliance. Identify how companies must account for societal norms and customs when creating a sales platform. I think at issue here with Robinhood, what we'll get into is their users on this program or trading platform that ostensibly was free, which was part of the problem we'll get into. It was geared towards younger traders, people getting into the stock market for the first time. And they used some advertising and tools and techniques that almost made it seem like a video game, or it's so exciting to trade. And the government alleged that kind of compelled people to make trades that were not in their best interest. And lastly, understand the core concepts and concerns of the regulators applicable to interactions with the investing public. Our audience for this case study is, of course, people who work in the financial services industry who want to learn more about compliance and the role that directors, managers, and support staff, the role that they have in leading and growing a compliant company. Terms we'll mention in this case study: the SEC, online brokers, know your customer, payment for order flow, which is something that I learned a whole lot about when I was a broker at Bear Stearns and UBS. Whenever you hear that a brokerage firm executes trades for free, they're not in business for free. They don't work for free. Robinhood, last I checked, is not a nonprofit. They're getting paid somewhere. So usually, what's another cliche? If it's free, you're paying for it somewhere. I don't think I said that correctly, but you get the idea. People were beginning to get the impression government regulators acknowledged or said that trading is free, and yet, as we learned, it might not have been in their best interest to execute trades for free because of the execution prices they were getting. So we're going to get into that a little bit. Let's talk about the current state of government investigations, of course. The securities industry functions as one of the most critical components of our economy by raising and investing capital from investors. Many of today's most important and valuable companies would not exist if it weren't for the ability to sell stock and having individual investors buy stock on publicly traded companies. So it's pretty common knowledge. The Securities and Exchange Act governs the laws and rules pertaining to securities on a federal level. Individual states additionally have their own security laws, known as blue sky laws, indicating the transparency intended by implementation of such laws. Companies selling their shares to the public and exchanges that support the trading of such shares are expected to adhere to the laws and standards of the Securities and Exchange Commission and applicable blue sky laws. Trading of these shares originally occurred manually in face-to-face transactions Of course, with technology, E-Trade, Robinhood, Schwab, all of these places that have rendered some brokerage firms essentially useless because some people are able to trade for next to nothing online. With the growth of these online exchanges, costs have come down, making it more affordable to trade, buying fractional shares in some cases of companies. And because of that, so many more investors have come in. It's no longer people that have big money to invest in the stock market through Robinhood or E-Trade. You can buy one or two shares and really begin to grow out this platform. With newer and younger investors, they may not understand the risk associated with trading of stocks. Some would argue Robinhood, especially recently, it's acting more as like a casino and promoting almost gambling without any methods of why people are buying and selling versus something that's really rooted in a long-term investment strategy. And, as I learned in my experience as a young broker, there's personal responsibility. People should understand when investing the risks that accompany it. And unfortunately, many of them will suffer significant losses, as has been the case with GameStop. Some have made a ton, some of them absolutely, destroyed. It was $400 a few days ago. Now it's down to $100. So it's essential that I think these companies, to the extent they can, understand their customer and put protocols in place as best they can and educate and inform. But at the end of the day, there is personal responsibility as well for everyone that's investing. Now, coming back to this case study with Robinhood, here was the situation. This fast-growing broker-dealer, Robinhood, began to attract many young investors with their app that was super easy to use, super enticing, almost kind of looked like a game, right? Video game. And going through it was fun. It didn't seem like the traditional boring, stock trading where you buy 5 shares of Coca-Cola at 40 and then someday 10 years later it's going to be 50 and you're getting a dividend for 3%. That's this stock or this app. It really isn't designed that way. It's like more exciting, making investing fun like a game or a movie rather than almost like a principled long-term investment pattern. This broker was the first to allow investors to trade without a fee. And now since then, there have been many other firms like E-Trade and Schwab. When you execute trades, there's no commission. But again, they're making money somewhere. But you could expect as a young, uneducated new investor, just like I was out of high school or going through college, that, why pay $50 commission or $40 commission or $20 online commission when I can buy it for free? And it can continue to entice people to trade more because there's no commission on the sales side as well. So they understood their audience, and they understood if you have a limited budget and just a couple $100 to invest, that you're going to get more trades and more investors if you say there's no commission versus even $5 or $10 a trade. You got $200 to invest, your own $10 commission, that's 5% right off the top in fees. That they realized quickly that would not be in their interest, nor would it be in the interest of their customers. As I just mentioned, many of these customers were new to investing, and they became very excited about the action that accompanied this very high frequency trade. Unlike a traditional investor, the more buy and hold and slow and steady wins the race sort of thing. I don't think there's a whole lot of slow and steady wins the race at Robinhood, and I think that's their culture and something they perpetuated and encourage because they want to make money and bring more people onto their platform. These investors, the government claimed, were also approved for sophisticated high-risk trading instruments and such as margin loans and options. If you trade options, you should be an experienced investor. Even I'm 46. I traded options, hundreds of millions of dollars in options as an executive when I was a stockbroker and money manager. I've been out of that game for a very long time. Of course, I'm now compliance mitigation and help companies manage government investigation to keep their costs down and manage the consequences of them. But as much experience as I have as a money manager, a former money manager in the option game, I really only feel comfortable selling covered calls. Buying puts is different because you manage your risk. But there are people out there who have no experience in trading or managing money in this game stock, that situation. You short a stock at 50, it runs up to 400. You have unlimited downside. That's why this phrase you heard, they're getting short squeezed. All the short sellers had to buy the stock back at higher prices, which continues to bring up or drive up the stock price. So short selling, very aggressive options trading should only exist for people who have extensive investment experience. In fact, when you open up an account, they ask you how long have you been in business or trading? You answer the question, they don't really verify it. So there is the personal responsibility component, I understand. But there is the issue, did Robinhood encourage people to engage in aggressive trades without them fully understanding the risk? The government said, absolutely, as we wrote here. They were quickly approved for sophisticated high-risk trading instruments such as margin loans and options. You got to have a lot of experienced people before you're trading options and going short and doing covered calls and all that crazy stuff. A little more background on this case study. Millions of investors turned to Robinhood in recent years, lured by this pitch of a no-fee trading and elimination of account maintenance minimums. Robinhood offered free fast trading through its online app, and it literally attracted millions of young customers. It grew into one of the biggest retailers in the brokerage industry. And of course, they were loved and adored by Silicon Valley. And as I read, the valuation is more than $12 billion as the time we wrote this case study. And I read they just raised another $3 billion. And clearly they have capital because they're doing their first Super Bowl ad this Sunday. Although internet savvy and not intimidated by the lure of online trading, many of these investors were unsophisticated with absolutely no experience. They viewed securities trading as more akin to gaming or sports betting. I mentioned that a little bit earlier. Some products like options, commodities, and digital currencies may have been riskier, if not totally inappropriate, for all of Robinhood's growing list of customers. There's no doubt, as I researched this company, the accounts they were opening, the types of trades that were taking place, there was almost a sense of almost willful blindness of ignoring the risk and the losses and the aggressiveness of people who in some cases lost absolutely everything. And I know in one case, someone who lost more than $700,000, unfortunately, took his own life due to the losses. Here's the key, where government investigators really began to step in. Robinhood's main source of revenue was predicated on payment for order flow. This is legal. Payment for order flow. This is legal. A legally and regulatory sanctioned practice, but one with very demanding and costly compliance components. So while it's legal, not every company has the compliance protocols in place to ensure that it's run smoothly, especially if you're growing so fast, which is this company is. It's easy to get lax on some compliance issues, especially if you view it as a cost rather than as an investment in your business and protecting your employees and your shareholders. It really depends the way you look at it. In life, we tend to ignore expenses as best we can, though it's easier to make an investment if you view it as such. But if you see compliance as an expense, it's going to be harder. You probably may not call compliance mitigation. You may not enroll in our compliance program. And that would be unfortunate because I'd hate for something bad to happen and then you have to do it because something happened. Be proactive. Do it now before things get bad. I beg you. This practice began decades ago, enabling market firms, this practice, I mean payment for order flow, began decades ago, enabling market firms to receive compensation by charging for their order flow and exchange listed securities. This practice engineered a great deal of industry controversy, regulatory scrutiny, and media coverage. Terms such as bribery and kickbacks colored early days of the practice, the results of which even went so far as Congress called in brokerage industry participants in for hearings and inquiries. They didn't like that they're doing this under the guise of trading's free without fully disclosing how they were actually making money. It's not unlike when I was a broker and there were some firms that would engage in extensive bond trading. And when a customer would get the commission, would get the ticket for the bond trade, it did not list the commission. So a lot of older investors believed that these trades were executed for free and the broker wasn't working for free. What they didn't understand was the broker was getting paid and they were paying for it because the yield on their bond was going to be lower. I can assure you a broker at Bear Stearns, Goldman Sachs, JP Morgan, they ain't working for free. So disclosure is key. Transparency is key. Compliance is key. And I assure you, these investors who were buying bonds wouldn't have had a problem with their broker making money on the bond trade. They just want to know. Government regulators wouldn't have a problem with Robinhood turning a profit and making money, but don't do it under the guise of everything's free without disclosing properly this payment for order flow, because that payment for order flow might not have been the best interest of their client. It might have been better for the client to pay the commission because the ultimate price they received might not have been as favorable. Again, someone's getting paid, and that's why when you hear free, be cautious. You're going to pay for it somewhere. Payment of order flow trading typically does not lead to something known as best execution. I just touched on that. Great, the commission's free, but maybe I paid 30 cents or 40 cents more for the stock. It might have been in my interest to pay the commission. I just touched on that. Best execution orders. Best execution occurs when a broker-dealer executes a trade at the most favorable price for a client investor seeking to trade in a security or financial instrument. Of course, you presume as an investor that every time you buy or sell a stock, you're getting the absolute best price you possibly can. You can't. Payment of order flow, on the other hand, allows intermediaries to take advantage of minor fluctuations in the price of a security and executing with third parties. So they make a little bit of money there, perhaps to the detriment of the person buying the stock who thinks they're getting this whole thing for free without recognizing maybe they pay 2 cents more, 3 cents more, which if you're trading thousands of shares adds up. Again, maybe it's in the interest to pay the $5 or $10 commission. While this price dislocation is generally very minor on an individual transaction basis, the pennies, of course, add up over time when trading is executed in significant volume. We're talking hundreds of millions of shares. Now it's easy to see how these companies are valued so highly, making so high, making so much money. This payment for order flow is a very big reason why. And again, younger investors might not fully question how they can afford to do this for free. They're getting paid somewhere. Robinhood's questionable actions began at the initial point of entry, when the broker-dealer's member representative reviewed the initial customer profile related to know your customer obligation. It was management's responsibility for the financial approval of the opening of the account. Robinhood's use of a remote access online platform did not demand an in-person interview. The requirement to prepare a comprehensive and thorough account solicitation agreement and the understanding of a prospective client's investment objectives, capabilities, and their knowledge of how the markets work is a mandatory compliance requirement. More importantly, the degree of risk that the individual's personal financial assets could support were essential for Robinhood's support of their clients' responsible investment and trading activities. Essentially, they could check off the box that they were going through the know your customer, but they weren't really doing an in-depth look or audit into is this really in the best interest of this person? Should someone who's 18 years old with no history of trading options or even stocks, should they be approved to trade options and be able to go short and sell naked puts and calls without being covered, that it could expose them to hundreds of thousands of dollars in losses? It was basic at best. And that was a problem. And you could argue, as the government did, they violated some state and federal security laws in so doing, and creating a platform or trading platform that, again, looked like a video game rather than, I think, what a financial firm should look like, while fully disclosing the risks associated. Now, I have no doubt Robinhood has the risks up there and the buzzwords up there. It may say it, but if the culture, if the daily activity within this site conveys a different message, those words are just sort of like, they're useless. They're just words on a website that nobody really follows. Analysis here. The SEC is a government organization created in the 1930s in response to the abuses in the U.S. securities industry that led to the Great Depression in 1929. The general purpose of the SEC is to protect investors and to keep securities markets fair and functional. As part of its role, the SEC advocates for full disclosure to the public, protects investors from fraudulent and manipulative practices, and supervises and regulates certain mandatory requirements applicable to all participants in the securities industry. This includes the requirement that broker-dealers sufficiently know their clients, something Robinhood in this case absolutely did not. They were too busy raising money, growing their valuation, and they were too obsessed with getting new customers and more people on their trading platform. Robinhood's Massachusetts blue sky statutes mirror FINRA and the SEC's requirements that require the firm and its representative to have a reasonable basis that each customer has a thorough understanding of the risk and rewards of the recommended security or strategy. These obligations must be made on a case-by-case basis of a broad array of customer-specific factors to determine this determination. So when I was a young stockbroker, there would be monthly compliance reports that would come out, and the compliance manager would come in and review trades for a client if they didn't have that much money, or they didn't have a lot of experience, or there were a lot of trades generating a lot of commissions and losses. It would lead the compliance manager to either question what's going on, shut it down, or no longer approve that sort of trading. I think that sort of compliance makes sense. It's a good idea, because then you don't have to deal with problems down the road, margin calls that people may not be able to cover, and some people who are investing for the long term make bad decisions and absolutely lose everything. So that wasn't taking place at Robinhood, and it should have. The SEC, along with the state of Massachusetts, brought charges against Robinhood, predicated on Robinhood's failure to appropriately and diligently comply with rules relating to know your customer requirements. Massachusetts went even further, accusing the startup of riding to success by unscrupulously pushing unsophisticated customers into risky investments. That's what I find the most troubling. Commissions for free, okay. Payment of order flow, getting a better price, okay. I understand that it's legal. That's gone on for a long, long time. But the idea of pushing investors into investments that is not best suited for them is a huge problem, and one where a government investigation made sense. And it should have been obvious, they said, that it should have been obvious for Robinhood's management that this aggressive trading style for young investors was not in their best interest. It should have been shut down, and targeting new investors who are frankly intrigued by this idea of like gaming or gambling and a little into a lot quickly via an online platform might not have been in their best interest, especially when you can do all of this trading ostensibly for free. Marketing terms such as free, fast, and easy are like bait for what may be categorized as rolling the investment waters, highlighting potential unsuitable or inappropriate product or investment activities. Several of Robinhood's younger investors had huge losses. As I mentioned earlier, one committed suicide after accumulating losses of more than $730,000. Failure to comply with financial and compliance requirements were other parts of contention, as was an assertion that development and programming algorithms should have been predicated on best execution rather than on payment for order flow, compensation agreements with various dealer and exchange market execution facilities. Robinhood's failure to comply with very basic and fundamental requirements specified by securities laws led to various abuses of know your customer, investor suitability, best execution, payment for order flow, transparency, and overall management's failures to maintain a culture of compliance, regardless of what they may have put up online. Ultimately, without admitting or denying the charges, Robinhood settled the SEC charges with an acceptance, waiver, and consent, which resulted in a fine of $65 million. It also took a major reputational hit and must submit to continuing rigorous oversight by both the SEC and state regulators. Furthermore, Robinhood now faces an existential threat to its principal source of revenue generated by payment order flow. While regulators approved Robinhood's payment for order flow practices, they demanded more expansive transparency and supporting documentation that would evidence the participation in the practice by both the broker and the market makers, along with an obligation to comply with best execution practices that validate the quality of the execution for the customer's orders and the broker's choice of routing and execution venues. This is a long case study. There's a lot to learn, but it's relevant for everyone who's involved in the financial services industry. With big government comes more investigations, and when you're dealing with people's money and opening accounts, and there's a lot on the line, you can expect scrutiny. It makes sense to take appropriate action. It makes sense to learn from Robinhood and go down a different path, whether you're a big or small firm or you're a broker looking to get into this business. Compliance is crucial in any industry, especially one that is so heavily regulated, with tens of millions of people potentially gaining or losing every penny they have. Recommendation: every broker-dealer should thoroughly and comprehensively inform their customers. They should know each client's investment objectives, background, knowledge of how the markets work in general. Each customer should have a full understanding of the products and the risks that come with buying and selling options and everything that comes with that. Such knowledge requires all broker-dealers to have well-informed, knowledgeable agents and other appropriate personnel to inform and maintain these customer information requirements, applying reasonable diligence to acquire essential facts. Turning the other way, claiming they filled out the form is simply not enough, not with so many people coming into this market. These compliance practices are even more demanding, where broker-dealers allow prospective clients to avail themselves of registration and use an online brokerage trading platform. In such instances, the software and network serving as the backbone infrastructure must be maintained at a level to support an appropriate level of network capacity. It should also include software to implement and support the requirements of a culture of compliance for the benefit of all the broker-dealers' clients and its support personnel. As with many startups, Robinhood should have been more comprehensive and demanding in their management and oversight of their practices, procedures, and checklists, not only with their account opening process, but throughout the resulting investment and trading activities that ensued. Training of all employees predicated on a comprehensive compliance manual actually distributed and implemented to all employees, along with required procedures and checklists, needs to be done diligently at every level from the top to the bottom. Management responsibility includes demanding regulatory compliance to develop, maintain, and ensure an ongoing culture of compliance. Business professionals, you have to understand the costs and consequences of government investigations, of misbehavior, in order to avoid the problems that Robinhood and scores of other companies are enduring and more will endure, because big government is absolutely back. And in many of these cases, they can easily go from civil and turn to criminal and become a white-collar crime investigation, where executives within this company could potentially, in time, a lot of these companies potentially face some prison time. As we wrap up here, the future state of this industry, new and innovative means for online trading will continue to evolve and grow. They will, however, require greater transparency and include more effective direct outreach and interactive communications with clients, not simply product marketing, but actual product education. For example, Robinhood could teach a free course to people who sign up that they want to do options to help them understand the risks and rewards of options, of covered calls versus naked puts, and everything that accompanies that. In fact, you could argue someone has to complete that compliance or risk program in order to even begin trading options. That's a measurable, specific step that they can do to educate their client and show regulators that there is personal responsibility involved. We've done everything we possibly can. This person still wants to invest. They have the right to do that. This is what we have done. This is our process to confirm that we are at least comfortable with the investment. That's compliance. That's being proactive, and that's putting the customer first. As we wrap up, at a minimum, customers must receive appropriate and comprehensive data to best inform them of underlying practices, which may conflict with the customer's best interest, and instruct customers regarding risky trading practices that may undermine the safety and security of the capital. As an example, like I just said, going through a little course or quiz or confirming the person really has the ability and understands what they're doing. This should not only be actions by their customers, but also for information pertaining to markets in general, in order to enhance the client's knowledge and expectations relating to trading on U.S. stock exchanges. And lastly, broker-dealers serve as conduits for investor trading, must also increase their interactions with regulators as to intentions and compliance efforts with regard to policies and practices that may reflect upon their customers. This openness and intention to engage, clarify, and maintain an ongoing dialogue with regulators should result in greater knowledge and capabilities for online brokers and their clients. Wow, that was a lengthy, long case study with some important topics. As we close, if you are in the business of managing or raising money, and you have people who are reliant on you for your expertise, or who are believing and buying into your marketing practices, it's essential that you're compliant, that you are disclosing. And if there is one mistake, one complaint, one loss, it's going to grow. And if you're not transparent and properly educating and informing your customers, it's a matter of time before a government investigation begins. So if you're in that space of growing and you don't have that compliance program, implement it, be proactive, put your customers first. If not, it's inevitable. Many of these companies who choose not to do it, who choose to evade, who choose to turn the other way, it's inevitable that more investigations are going to come. In this case, $65 million they settled for. The brand reputation and damage, probably more than the $65 million they settled. And it takes a long time to undo and overcome that. And all of that can change by compliance, by implementing a program that people can learn from, that's practical, that they can relate to and understand. And that's how I will close this video on Robinhood and dealing with violating state and federal securities laws. Thank you for watching this lengthy video. Subscribe to our channel to get more notifications on videos, and go to Compliance Mitigation and enroll in our Compliance Mitigation 101 program. Thank you so much for your attention. I look forward to returning soon. Bye-bye.